Thursday, the 27th of September. Let's have a bit of a recap of what happened last night with Janet Yellen. That kind of sets the stage then for a couple of things that we're looking at this morning, and then a look ahead to today's session and what we can expect. Looking at the charts then this morning, what you can definitely see is both major pairs. So the top left-hand corner, both pairs under pressure. So persistent dollar strength. If you remember, we were up about 0.5% in the dollar index yesterday. We've pretty much already added that in the session so far. So the dollar continues to make movement on the upside. This obviously comes post last week, what we had with the hawkish Fed. And then on the flip side of this, you've had the German election, which has created, although there is a strong agreement that a coalition eventually will be formed, at this point there's still a lot of details to thrash out before that so-called Jamaican coalition can be put together. Also as well, this has kind of lessened the hand of Angela Merkel in order to support Macron, who you probably would have seen gave a European integration speech for about 2 hours yesterday, talking how basically Europe should have a one coordinated, cohesive policy, should be governed by one kind of central point with one finance minister for Europe as a whole. Now, all of this kind of European integration view, Macron was banking on the fact that he'd have support from Angela Merkel and Germany, given they're the most influential member within the Eurozone. That hence the reason why, since Macron got appointed a few months ago, he's been cozying up to Angela, if you like, trying to facilitate this relationship. However, what's happened in the election, although Merkel to remain Chancellor, obviously she's lost some of the power and she's going to have to make some concessions to those other parties, the Greens and the FDP, of course, in order to get them on board. So a bit of euro weakness, obviously, in combination with this hawkish Fed, has led to a pretty decent downward trend materializing in the euro currency. And then if you're looking at sterling, well, sterling continues to remain under a bit of pressure. So looking slightly longer time frame, you can see we've broken back below. This is a daily continuation chart. We originally broke that kind of mid-July resistance level, which was a pretty important level. We retested it close to that level in the beginning of September. And we broke above that. That allowed a bit of an extension over the course of the last few weeks at the earlier part of this month. However, we've pulled back below that level. So Theresa May's speech obviously on Friday, but really there hasn't been a great deal of traction to come out of this fourth round of Brexit negotiations that are ongoing. So again, you've got fundamentally positives occurring for the dollar and negatives on the European and on the British side. So consequently, it's both pairs remaining under some pressure. Not only this, and we'll look at it a bit more detail shortly, we also have, of course, today the unveiling of the further details to the US corporate tax plan. And really, if you think about the dollar movement over the last 24 hours or so, this has been very much a repositioning of not just the continuation of hawkish Fed commentary, but also the anticipation that this is going to be coupled with a fiscal stimulus. And if that can happen with significant corporate tax measures, then this should be dual forces to further push the dollar, and hence the reason why you've had this this repositioning support for the dollar over the last 24 hours. What else have we seen? Well, this morning, we were just looking at about 20 minutes ago, the DAX took a bit of a pop on the upside. It doesn't look anything particularly fundamental. Technically, we did break that high that was seen at the end of last week, and it looked like some stops got run because it was a pretty quick pop up to that R2 on the daily pivots, and we've pulled back quite a bit since that point. Consequently, though, with European equities on the front foot, that has weighed on Bund futures, and so Bund's also down about 42 ticks this morning, having just pared back most of the gain that was seen at the beginning of this week. Elsewhere, with Equity markets, we did have a bit of a mixed close on Wall Street. It was basically flat in the S&P, but the Nasdaq, making up for some of the underperformance earlier in the week, was up about 0.25%. The Dow was pretty flat. But as I say, with European equity sentiment fairly positive, US futures have also started to grind up. The S&P here back up to R1. So consequently, we've seen gold continuing to take back some of the initial spike that we saw late on Monday afternoon. So looking at gold prices where we are at the moment, we are pretty much exactly to the point of where those North Korean foreign minister comments came out, when he talked about taking whatever countermeasures are necessary and also shooting down American bombers, even if they're not flying in North Korean airspace. That's obviously a significant escalation in the rhetoric. We spiked higher in gold at the time, however that move completely taken back already. And notably, we're sub the $1,300 level. We have got close to coming back up to test that overnight in Asian trade before then trending back down lower. With this kind of moderate risk on appetite, the yen also weaker, so dollar yen's also seen higher this morning to kind of fit the picture. Okay, so let's have a quick recap of some of these stories in a bit more detail. Firstly, there was Janet Yellen. Now, we were awaiting this shortly after 5:30 p.m. Last night, and this was the kind of headline that the news agencies are running this morning. In summary, Yellen says it's imprudent to stay on hold until inflation at 2%. She suggested the Fed may have misjudged the strength of the labour market, the degree to which longer-run inflation expectations are consistent with our inflation objectives. She cautioned the Fed should be wary of moving too gradually, in part given the possibility that labour market could overheat and create inflationary problems down the track. So if you were thinking that maybe there's an uncertainty about the future outlook for inflation and that was going to shackle the Fed's ability to be able to tighten policy going into year end, well, this statement's kind of put that to bed. What you have had with the Fed last week, obviously the commencement now of quantitative tightening, which will begin in just a couple of days at the beginning of October. And now, if we start looking at what the market's pricing for a Fed interest rate hike, well, this is what it's looking at the moment. We're now priced for a December rate hike on federal funds futures at 76.4%. The Bloomberg measure tends to differ slightly, but that's still up at about 66.6%. And so this is quite similar to what we've seen really throughout this year. If you remember the dot plots that the Fed issue and the kind of trajectory that interest rates on the path for that year, say 2017, are expected to go, the market's always been priced much more dovishly. And what's been very notable this year is that so far she has delivered, Yellen and the Fed, exactly what their intentions were when they initially said they were going to do 3 rate hikes back in December of 2016. Each time the market has underpriced that happening, only then for Fed communication to step up, continue to sound hawkish again and again and again, to the point of which then market pricing has arisen on both occasions almost to 100%. So then it enables the Fed to hike interest rates, but then typically, given that they tend to move when the summary of economic projections comes out, they sound quite dovish with the projections. So you get this dovish hike scenario, and it almost feels like they're prepping up for a similar thing here, with the tightening going on with the balance sheet, and now with this December hike looking more and more probable, particularly if Trump can deliver on the corporate tax side and lift expectations of a fiscal boost, then certainly this December hike looks more and more like a done deal. Let's have a look at Trump then and what he's been saying, because he continues to be very active on several different fronts. Not only is he dealing with this whole domestic issue about the NFL protests and so forth, the more market sensitive stories have been about the corporate tax issue first and foremost. So the reason why this is in particular focus today is because it's later today, in a few hours time, we're looking to the president to unveil some more details. The one thing I'd say here is that actually you're probably not going to be particularly surprised, because most of the detail has already come out. So just recapping, Trump and Republican leaders will announce this plan today. They'll propose a top individual rate of 35%, but leave to Congress the decision of whether to create a higher bracket for top earners. The rate on corporations would be set at 20%, obviously down sharply from 35%. And they will set out a plan of 3 tax brackets for individuals, 12%, 25% and 35%, down from the existing 7 rates, which top out at nearly 40%. So quite a bit of detail here has already come out. The one thing that there hasn't been detail on as yet, from what I've been reading this morning, is about this one-off international money sat offshore. So companies like Apple, Alphabet, Microsoft, who obviously have a large cash pile out in, say, Dublin in Ireland because of the low corporation tax at 12.5%, a low one-off tax break so they can repatriate that money back into the US as a form of stimulus for the economy. That percentage has not been unveiled as yet, so that will be something which we got to look out for as well. So that's the corporate tax side. And then if we start looking at the North Korean issue, this is the other thing obviously that Trump has been talking about last night. And as I mentioned, the very aggressive nature of the language used by the North Korean foreign minister on Monday has had Trump respond, saying that we're ready to use devastating force on North Korea. We are totally prepared for military force if needed. So at this point, as we've just said, if you're looking at the charts this morning, I mean, if anything, there's a risk on the environment. Gold has reversed the Korean move from Monday, and so these comments aren't really being factored in to a great degree in terms of moving the market. I guess the important thing here is that this is really the key phrase. He says, we are totally prepared for military force if needed. The fact is, it hasn't got to that point yet. Obviously, if it were to get to that point, that's then the new level of this situation becoming a big dominant theme. And actually, that's probably one of the big tail risks that could, between now and I think it's December 15th when the Fed have their decision, that could restrict them from actually being able to execute that December hike. If this Korean issue was to get to that point of the US using military force, then the likelihood is that debt hike would be off at that point. So that's the kind of situation at the moment with Trump and with the markets. A couple other things to be aware of though. This was a graphic that I just wanted to quickly show you, and this is what I mean by the communication tactics of the Fed. You can see if we go back to just the beginning of September, this was when we had non-farm payrolls, and if you remember, I believe it was on the 1st of September, and that was when it came in a full house, worse than expected. Worse headline, worse wages, downward revisions. Yes, it wasn't by any stretch of an imagination a disaster, but it was weaker than expected. And at that point, the probability of a 25 basis point rate hike by the Fed fell to about 21%. So in the course of the last 26 days, we've gone from 21% to 67%. You know, this is a real coordinated effort by the Fed, encapsulated by Janet Yellen yesterday, and also her press conference that she delivered with the Fed statement in last week's announcement of the FOMC. What's been very interesting actually, and let me just jump quickly to the calendar, what you'll notice, and this was very similar yesterday, is today we've got another slew of Fed speakers. If you remember yesterday, we had Mester, Brainard and Yellen. Today we've got Bullard, Brainard and Rosengren. So ask yourself, why are we seeing so many Fed speakers? Well, this is a perfect strategy of the Fed. How do you manipulate market thinking as to what your intention is when the market has been so mispriced from what you've been saying? Don't forget, although the market pricing has altered drastically over the course of the last few weeks, the Fed language and message has not deviated. They've always said they were going to hike rates and tighten the balance sheet before year end. The only thing is we didn't believe them. But if they keep saying the same thing again and again and again, eventually it starts to get priced in. And this is what we're seeing at the moment. So seeing lots of Fed speakers is really a tactic done so that when Yellen gives an official speech like yesterday, you've already got these other speakers kind of awaiting in the wings to help guide the market further should they misinterpret what's being communicated. And so in terms of the Fed speakers which are coming later, Bullard, Brainard and Rosengren, if you'll note, Brainard and Bullard are both generally slightly more on the dovish side. You can know what you expect to hear from Rosengren being a soft hawk, but I would be expecting even the doves to be fitting more with the general neutral to leaning hawkish stance of a December hike is likely to happen. So yeah, a very effective job that the Fed have done to bring these expectations back higher in the recent weeks. And hence now we're seeing this more dollar strength as the market's coming to that viewpoint, then of course in combination with the corporate tax deal on the fiscal side. Finally, a couple of other things that you should be aware of. Overnight we did have China's industrial profits jump. Actually, it was the most in 4 years on a commodity surge. So thanks to the government-backed construction boom that is helping Beijing trim higher levels of corporate debt without tripping up the economy. So again, this is it's a difficult one to really read too much into, because the government has such a direct impact into things like these infrastructure building projects on such a mammoth scale in China that it does tend to cause these big surges in commodity prices, and hence industrial profits do leap. So although this is a 4-year high, again, I probably wouldn't read too much into it at this point. Looking at oil, of course, we had the API crude oil inventories last night, so let's just have a quick look at that. Now, I did have a question waiting for me this morning when I came in, and this was about why did oil sell off yesterday. So obviously we're talking about, let's just remove the retracement that we've had overnight. I guess they're talking about this little dip here. And so I think a couple of things you've got to put into context. For one, this stronger dollar story that we've just been talking about. Don't forget the dollar's been up about 1% in the last 24 hours, and as such then that generally is an inverse relationship, in combination then with the fact that crude oil saw such a big rise on Monday, chiefly led by Brent hitting a fresh 2-year high on the back of that Turkish news, and so WTI West Texas Intermediate following in sympathy with that move. So a bit of profit taking and also the dollar strength, because there really wasn't any definitive new fundamental news to cause that drop lower. What's happened then overnight? Well, if we move over our mark on the chart to this candle, this was the API crude oil inventories. So you can see we're already recovering after that brief flirt below pivot in yesterday's session. We are now back above a 52 handle though. And you can see we've got close to 52.03 we printed before a little bit of a bounce to where we are at the moment. So keeping on the pivot here as a potential floor until we get the crude oil inventories later. But oil obviously has moved up a little bit post API. So what happened? Well, the numbers were significant because for crude we had a drawdown of 761,000. The reason why this is important is because it was the first draw since August. Expectations were for a build of about 3 million. So obviously a bullish factor. If you remember, in the wake of Hurricane Harvey, the crude numbers have been pretty significant, large builds, given the lack of demand because of the infrastructure onshore of the refineries being impacted. So not having the requirement then for the raw crude product. And so crude builds were fairly large due to the impact. And now we're seeing a bit of normalization post-Harvey. And so crude was a drawdown, which is obviously bullish. However, do be aware that Cushing was a build of 1.6, which actually is the biggest build in 6 months. Gasoline was a build of 1.47, the biggest build in 7 weeks. So on the balance, it is a little bit mixed, and obviously with the DOE numbers, you do have to monitor quite closely the US output figure. But overall, just given the fact on that draw in the main headline figure, prices have moved a little higher this morning. Okay, finally, away from the speakers, let's have a look at what economic data we've got to look forward to on the calendar. Not a great deal coming out this morning. So all of this data, I'd say, is non-market moving, that inclusive of the CBI distributed trade report from the UK. I don't think I've ever seen sterling really move much on the back of that. Then going into the US afternoon, you'll get building permits, but these are revisions, so really your headline figure is the durable goods report from the US. You've also got pending home sales and then the DOE crude oil inventories. I don't have a set time for when Trump will be delivering the corporate tax plan. However, I'll be on the mic and I'll update you as and when I get more clarity as to the timings on that. But one would imagine it's probably going to be something like between 1 and 3 o'clock or so this afternoon, so in the US morning. I'm sure that Trump would want to fit it in before UK and European traders wrap up for the day, so that he gets maximum bang for his buck when he announces the details on this plan, in order to move the market the most. Okay, that's your briefing for this morning. So any questions, of course, just let me know. Otherwise, thank you for listening and have a good day. Thank you very much.